So thank you for joining today. I'm Tori, Strategic Partnerships Manager at FinTech Australia, and we're thrilled to present today's webinar with Red Hat, Prepping Your FinTech for Success. If 75% of FinTechs fail, how do you become one of the 25%? We will be doing a Q&A, so any questions throughout the webinar, please add them to the Q&A section below, and our panelists will be sure to get to these at the end of the session. So with that, I'm going to hand over to today's moderator, Ben FinTech Ford, Head of Enterprise Sales at Tiimely, which you may have formerly known as TikTok, and he'll introduce our panelists. Thanks, Ben.
Awesome. Thanks, Tori, and thanks to Parpera and Red Hat for joining us today. Daniel, it's been a little while between drinks. How are you going? What's happening in the Parpera world? And perhaps for anyone who isn't familiar with Parpera, maybe you can just give a high-level overview of the business and what you're trying to achieve.
Thanks, Ben, and thanks, Arvind from Red Hat and FinTech Australia for pulling this together, and Ben for moderating as well. Always a pleasure to rejoin you on these panels. So just a little bit of background. Parpera means fair wallet in Latin. It embodies our purpose, which is to make business easier for people through providing a fairer and more transparent proposition. We do that by allowing sole creators and company directors to open up a business account, debit card, invoicing, ability to receive payments by card or bank transfer, save for taxes, you can earn a return, and we help you lodge your taxes as well and provide you insights along that end-to-end value chain. We also recently launched the marketplace where we have a insurance offering from NRMA. So Ben, yeah, there's been a lot going on since we last spoke in September, and as you're aware, we relaunched in July this year. We're growing between 40 to 50% month on month. From a member perspective, we have over 100% month-to-month growth in payments, and I'm sure we'll dig a bit deeper in today. But can we say Parpera is a success? Well, I think success is relative to where you are in the journey. Certainly, in the earlier stages, we've got some metrics of success, but there's still a long way to go in terms of our North Star. So happy to dive into that today and share the learnings.
Fantastic. And it's been great to see the ongoing growth of Parpera as a customer and user. All the additional features coming online are great to see. So congratulations and well done. And Arvind, welcome. It's a pleasure to see and meet you. Red Hat might be a newer name to some of the audience, particularly in the FinTech community. Could you perhaps maybe give a bit of a high-level sort of idiot-proof, for me, overview of the Red Hat business and maybe some of the problems you're helping to solve for your customers here in Australia?
Sure, Ben, and great to be on the panel with you and Daniel. Let me start with a very simple overview of what is Red Hat. So Red Hat is a leading provider of enterprise open source solutions. For people who are not familiar with open source refers to a type of a model where it's community-based. The source code is freely available. This means that the underlying code is accessible to the public, allowing developers to use, view, modify, and distribute it. So it definitely leverages the power of community. This is where Red Hat comes in. We provide enterprise-grade open source solutions. An example of that is Red Hat's containerization solution. So any financial institution or FinTech looking at innovative solution, adopting microservices architecture and container orchestration. This is where a Red Hat's OpenShift solution can help in building, deploying, and managing containerized applications. What does it mean for FinTechs in general? We are seeing a lot more adoption of open source by FinTechs everywhere, not just in Australia. And then this gives them a bit of an edge in terms of driving innovation and differentiation when competing in this environment.
Okay, thanks, Arvind. And just to sort of play that back, just to make sure I've sort of understood that correctly, it sounds like from what you just said there, open source is sort of used and adopted at the enterprise level, but maybe hasn't been so adopted in the FinTech community.
So there is a slight difference. Open source is available as a version which is community-based. So that's freely available. What we provide is an enterprise-grade version. And what this allows you is, if you're buying Red Hat based solutions, definitely the underlying is based on open source. But what it is important is, when you are in a regulated industry, when you are in, especially in terms of financial services, you want something which is supported, you want which is secure, something which has been hardened and tested against hardware or infrastructure solutions. So this is where Red Hat comes in. Adoption of open source, I would be very open here, Ben. It is actually, I would say the increase in adoption of open source was driven by FinTech. Because they saw this as a very good enabler for driving their business model.
Awesome. No, thanks for the clarification. So we can sort of delve a bit into some of the, I guess, the sort of strategic methods, and also maybe some of the tactical methods that can help FinTech sort of get themselves into the sort of success end of the scale. Let's perhaps just start with a bit of a sanity check on where we are today at the end of 2023. It feels like it's been a pretty tough year all round. I don't think I'm charging anywhere at the moment. I'm probably limping towards the end of the year pretty slowly. Daniel, you're sort of deep in the FinTech trenches. What's your take on where we are today, and what are you sort of hearing around the traps from the people that you speak to on a regular basis?
Yeah, thanks, Ben. So perhaps we'll start with a more macro kind of global view, and then I'll work down to what we're seeing in Australia and sort of my peers in the industry as well. And I think from a global perspective, I mean, there's been a somewhat deflated view of FinTech in the last 12 to 24 months, largely being driven by the changing macro conditions. We've had an inflationary environment from both inflation and interest rates. That's driven a lot of investment dollars, or reduced a lot of investment dollars into the industry. FinTech is one of those sectors that requires capital to grow. And a lot of the early business models around FinTech required a lot of capital before you could reach profitability. We're starting to see some of the early FinTechs, say in the UK, from the 2016 kind of vintage, starting to reach profitability, but they've been heavily venture funded. In the consumer space, that required a lot of venture funding. In the B2B space, we've seen a lot of the B2B FinTechs start to actually reach profitability sooner. And I believe they've become more attractive from an investment perspective as well globally. What does that mean for Australia? Well, in Australia, we've kind of been through a first wave, and some may call it a second wave, but we're certainly at the end of a wave. If we go back to 2014-15, when FinTech started becoming a term, you saw some of the early lenders come to market. In around the 2017-2018 period, we started to see neobanks come to market, largely consumer focused. A lot of those have either been sold or gone out of business. And then I guess around the 2020-21, we saw the start of more of a B2B movement as well. And that's when Parpera was born. So we were born in 2020, and we've been in business now for 3.5 years or a little bit longer. In terms of what does that mean for us? Well, we were seeing in 2020, 2021, there were high valuations. There was a lot of money around for FinTech. But being in Australia itself, we always need to be really disciplined. So there's always a focus on how do we get to revenue, and what does that path to profitability look like? So I think from an Australian perspective, we've always been forced to be a bit more disciplined. And so when the market did change, the levers that we had to pull, like we already were running quite lean, and particularly Parpera as well. Fast forward to today, what we're seeing is, I would say, and this may be more of a negative view, there have been a couple of silent deaths where kind of businesses that were around have sort of just quietly gone into the background. And so some that were strong in PR all of a sudden went quiet. And usually when they go quiet, that's a strong signal that they may not be around for much longer. But we aren't seeing many new FinTechs come to market in terms of that direct consumer or direct to business space. But I believe there's a lot of opportunity. We're seeing a lot in the infrastructure space. So building the underlying infrastructure to bring FinTech propositions to the market and embedding it within other businesses. And I think we'll continue to see the B2B space become attractive in the next 12 months as well. I think there's an acknowledgement across the industry, both locally and globally. I was in Singapore 2 weeks ago for the Singapore FinTech Festival. There are still a lot of people building. There's still a lot of capital around. Just getting access to that capital, though, has a higher requirement and a higher bar. And the return required needs to be higher as well, because as interest rates go up, investors need to be able to justify a higher return. And so it really comes back to the fundamentals. of building a great business, focusing on a market that's underserved, having a value proposition that resonates. But to be more specific around like our local peers, it's really tough for founders right now. So it's balancing growth. So you need to always show growth. You can't cut costs completely. Then you don't have a high growth business. And to run a fintech and to get venture funding, you need to show that you can be a high growth business. Equally, you need to do more with less. And so you need to spend less. You can't spend as much on paid marketing. You need to find other channels. And so the conversations we have is it's a bit of a roller coaster. And founders but founders are quite resilient, and they're finding ways to make it work. And so I think that those that do emerge from this downturn will be in a really good position to take advantage of the next wave.
Yeah, thanks. And sort of, Arvind, just sort of following on from that, are you still seeing that same sentiment sort of going into larger organizations as well? And then the second part to this question for you is, what are you seeing in Singapore and APAC more broadly? Is it a similar trend, or is sort of, is what Daniel mentioned about the Singapore FinTech Festival and what's happening there? Are you seeing that? Is it sort of different in Australia to elsewhere in APAC?
So Daniel has covered it well. I would say that the most important aspect was this is capital intensive, and the return on investment is a longer cycle. And this is what has put off a lot of people. There was a lot of noise in the initial period, but what has slowed down the appetite from venture capitalists is exactly around this. Also, there have been some questionable business models. And I would emphasize that point a bit more. Yes, we are a technology company, but you cannot just take technology and expect to get returns on it. You need a solid business model. And I think this is where funds are there in the market. Let's be very clear about it. But the question which is being asked is, how solid is the business model? So there is a lot more scrutiny and governance which has come in. Coming back to it, the sentiments from FinTech Festival here, there's a lot of appetite on both sides. There are a lot more players coming in, but the journey is slower and longer. So the expectation and milestones are extremely important. I definitely think there is a lot of opportunity in this space. Customers are actually expecting. The traditional financial institutions are going to be there, but they are also looking at different fintechs coming up with different ideas and ways of solving the daily problems that they have. So the appetite from the customer side is also there in terms of jumping on board as a customer.
Yeah, I'd agree with that sentiment from Arvind. Ben, one thing I'll add about the local context as well, we're in constant discussions with the large accounting platforms and the large banks, like to exchange learnings and the journey that we've been on. And there is an acknowledgement that, particularly the segment we serve being micro businesses, that they're underserved, and the banks or accounting platforms aren't well placed to serve them. So they're looking for solutions. I think what we'll see is more collaboration in the future between institutions and startups. And that's been a trend that came out of Money 2020, Ben, that we were there as well in June this year. I think there's an acknowledgement that a lot of the institutions don't have the in-house capabilities to build these in a lean and fast way to learn and iterate and launch. So a lot of them sink millions of dollars and never get to market. And so there will be more collaboration, but they do have distribution and they have funding. And so what you'll see is more collaboration between enterprise and startups, I believe.
Actually, just to jump in there, and I think what Dan mentioned is extremely important, that in the past, the larger financial institutions looked at a lot of these fintechs as competition, or they would not survive. But I think the collaboration piece that Daniel brought up, the ecosystem is now accepted and viewed as complementing the offerings of larger financial institutions. I see in the future, there is a lot of possibility of these large financial institutions becoming bigger investors in the fintech ecosystem, seeding the fintech ecosystem, because they see them to be more agile and also brand-wise better accepted by the new generation.
Yeah, I think particularly from an Australian context as well, aside from the bank-led corporate venture capital investors, there is no dedicated fintech fund. So it makes sense from an Australian perspective that you will potentially or likely have a bank that invests in you. And we've seen that play out across the market already.
Yeah, awesome. No, thanks for that. And please, guys, keep jumping in. It makes my job very easy. It keeps the amount of words I have to say down. So I just want to sort of go back to, I think it was a point you made there, Arvind, around sort of maybe some of the mistakes, maybe some sort of potentially a lack of rigor in the business or commercial models that startups are going to market with. I guess the question is, are you seeing sort of common mistakes being made repeatedly that you think would be fairly easy to remedy in the startups that tend to not make it, or maybe have a fast start but then sort of fizz out and fade away reasonably quickly? I'll start with you there, Arvind.
Yeah, and I'll leave Dan to answer the questions around business and commercial, because I think he's better equipped to do that. But on the technology side, we've seen some common mistakes. The first one is more, and I would say this is the basic one, is more around architecture. In the time to market element, trying to go live and show quick onboarding, because the focus has been more on revenues. And how many customers you can onboard in the initial phase. I think the medium to long-term view has been not taken into consideration when looking at the architecture. That has been, I think, a big element of it. What we see with a lot of fintechs is either they're very good at business side of things, or either they're very good at technology side of things. The mix has been a bit more challenging, because when they're very good at technology side of things, the business model is not up there. And when they're very good on the business side of things, they haven't thought through the architectures and the 3 to 5 year roadmap. And in the architecture side, what we see is a classic issue. What surfaces in 2 years is, as the transaction volumes go up, as the number of customers go up, they start having performance issues. And more importantly, they start having security issues in terms of scaling up, ability to scale up. And what we are seeing, at least in the last 1 year, is there's also a lot more scrutiny from regulators. So some of these fintechs got away with not being as heavily regulated, but now the question is being asked is, the financial institutions, they should also fall under the regular scrutiny, which means that they're being asked the same question, that how well are you equipped to handle these transactions? What is your backups or performance? How are you going to take care of security? All of those things are being asked of them, and these things haven't been thought through by these fintechs. So my view is the classic failure is looking at a medium to long-term view. This has not been taken into consideration. What has been looked at is a short-term view. Let's get up and running.
Dan, anything to add there from what sort of you're seeing on the ground?
Yeah, I would say maybe I'll provide it from like our own point of reference in terms of the way I thought about starting Parpera, is that we always wanted to build a global business. We've always said we'd start in Australia and eventually we would go global. Did I know it would take 3.5 years to launch twice and go on that journey? No, I didn't. But from day one, we architected the business to be able to scale and go global. And that meant, from when I think of architecture, Arvind, I think of it as it's often used as a technical term, but I think of it's the whole business. And prior to Parpera, I was in management consulting. I specialized in digital transformation, and we'd always have these tech teams and business teams that we would push out to the clients. But to me, it's all one and the same. So you don't build a business today without considering the business and technology implications. The way I like to think of it, it's market, customer, problem solution. What's the technology need? What are the operational considerations? What are the compliance considerations? And what's the money you need to go and make it all happen? And so we thought through each of those building blocks as part of starting Parpera. Sure, it may not happen as quickly as we want to, but we know that when it does happen, we're prepared to go on that journey. And particularly the point around, not a lot of people know the background of our story, but going through a bank partner failure and being able to re-platform, that was baked into our architecture. So we knew by looking at, so one of the key points I had around this, around what do people get wrong, is the global context and local context. So starting off with the context of the market, of what's happened elsewhere. The reality is in Australia is that most fintechs that come to market are doing something that's probably been done elsewhere. We're at a point in the cycle of development where there aren't that many new ideas. They're augmented for the local market, and there are new things that come as a part of that. But if you look at other markets where it's already happened, for example, before we started in 2020, there were already FinTechs in the UK that had lost their banking partner and had the platform. So we knew that it was very likely that either we'd lose our banking partner or we'd get too big for our banking partner and need to change or internalize the functionality that they provided as we scaled. So that enabled us from an architecture perspective to build in a way that we could disconnect and reconnect as we needed. That's meant today that we can actually plug in other banking partners as well, whether it's in Australia or in new markets, which makes it easier for us to scale. It meant we could recover when our last banking partner failed. The other part that we did to get to market quickly, Arvind, to around your point, was that we decided not to build all the underlying infrastructure, but rather partner for it. And so we talk about open source, but we also like to think about open architecture or ecosystem architecture. And so Parpera brings together Wise for accounts and cards. We have a zero integration for bank fees to an accounting platform. We have Stripe for payment processing. We use Westpac to generate interest on funds for people. And so we build an ecosystem, and that ecosystem builds in resilience into our business model.
The only piece I'll jump there is just to clarify that not all fintechs make those mistakes, just to be very clear. But these are some of the common ones that we have seen. And the piece I definitely like what you mentioned, Daniel, is architecture is not just a technology concept. It's a much more overarching concept where you look at all aspects of business model and how then technology enables your business model, and how then you also leverage the ecosystem. I think that is an interesting point you mentioned, that not trying to build everything rather than what is there in the market from an ecosystem perspective, leveraging it. That definitely helps, not just from a time to market, but also from a resilience perspective, because then you have choices available.
Yeah. To add to that, it comes back to sort of what's your value proposition to the market and what do your customers care about. Our customers don't care about bank accounts. They care about getting paid and be able to make payments quickly. And so no one wakes up in the morning and says, I want to open a bank account. And so therefore, if we follow that as our thesis to what we bring to market, how do we add value? Well, we help you get paid simply and quickly. So we need a way to solve that. But they don't care whether we build that ourselves, if we're regulated ourselves for that. They just want to know that it works and that it can solve their key job to be done. And I think when you start to think about it like that, you can start to structure your unit economics in a different way. You've got different efficiencies as to how you go to market. And in terms of the way we've selected to build our business, it means that we focus on service delivery and innovation, and our partners focus on the back end around, we do compliance, but we've got support from our partners to then also have transaction monitoring, compliance, and take care of a lot of the heavy lifting around that as well. Making sure that all the plumbing of the financial system works. And that takes a lot of stress away from us.
And Arvind, just to go back to something you said before, in terms of banks partnering with FinTechs, potentially acquiring FinTechs further down the track and things like that, presumably the more robust their architecture is and the more sort of mature their tech stack has been from day one, the more likely they are to pass through the DD or pass muster with any sort of larger organization looking at them, correct?
Yep, exactly, because especially so when the investment comes from financial institutions, then venture capitalists, because financial institutions, everything they do, they review it from multiple lenses, not just from a customer, that what value proposition does this business model bring. But I would say the financial institutions are more guarded, especially looking at governance, risk, and compliance, and not just from an internal perspective, but from a regulator perspective, because anything they launch comes under scrutiny, even if it is a part of their innovation lab or as part of their venture capital funding. So the scrutiny is a lot more there.
Yeah, I think it's a really good point just to add to that FinTechs have a very, I guess, a unique role in the ecosystem, whereas we're given the keys to operate in a highly regulated, highly important function in society. So once you're providing access to people to move money, they can go and do all sorts of things. Most of those are good things, but there are bad actors out there. And so the same people that are using your solution to do good things, they also exposes you to people that don't want to do good things. And that's where security, compliance, governance becomes really, really important, because it doesn't matter if it's $1 or $100. If it's fraudulent or if it's money laundering, it's illegal, and it can be aiding and abetting activities that you don't want to be involved in. So to Arvind's point, like, you need to be at the same level of security as what a bank would have to make sure that you're not facilitating those types of activities.
And I would add one more point, because I would say at least till a year ago, the regulators were a bit more confused as to how to regulate fintechs. Because if you're doing the front ending onboarding of the customers, and like what Daniel mentioned, the back end, they don't care where the account exists. Who owns the KYC process, the know your customer process, the onboarding process? Now, I would say there's a lot more rigor. And these things are being scrutinized a lot more. Also, on the other side, I think the challenge is also for the fintechs a bit more the stickiness from a customer perspective tends to be less because of the offerings provided, because it's not a multi-product offering from day one, which means that if I don't get it here, I go to somebody else, unlike a larger financial institution where you have 4 or 5 things as relationship with that institution. So the degree of caution which needs to be put in, I would say, is higher on fintechs.
Interesting. Interesting. And I suppose in the work that you're doing, particularly with enterprise customers and helping them sort of deploy or spin up microservices more quickly and with sort of, with an agile methodology, does that potentially represent an existential threat to fintechs? Are they sort of going to see what fintechs are doing and some of these banks on the digital arms go out and rampage?
It's a fascinating question. So I would say first things first, what it has done is fintech as a phenomena has forced financial institutions to look at 2 things differently. One is how they service their customers, and linked to that is what changes they need to do in their organization, be it the operation side of it or be it the technology side. So I would say the fintech phenomena has driven this disruption in traditional financial institution. Now, does that mean that they've completely revamped themselves and become completely technology savvy? No. There's a lot of legacy landscape that they have right now, which they need to sweat the assets, and they cannot change overnight. But definitely on the customer engagement piece, there's been a huge change. So what they provide all the way from mobile to online to even, I'm using the term in the fintech call branches. Yes, they're trying to get more seamless. They're trying to get better. They're trying to get more real time. So all of that has happened. Has it shifted in the middle office? Yes, on the product manufacturing side, they've gotten better because of the technology shift that they have had, because it allows them to get newer products in a timely fashion to the market. But I would say, have they become fintechs? No. Because being a fintech is more than a business model and technology. I think it's a mindset. And I think that takes a huge culture shift to be able to get there. And as I said, the other aspect comes in is that they are large organizations, so they are not as agile as they expected to be. And also there are some expectations from regulators out of them, which are those expectations are slightly different than fintechs. So that definitely doesn't give them the agility and the time to market. But I think this is where they're being smarter about collaborating with this fintech ecosystem, which allows them to get the agility, which they might not be able to build as fast.
No, well said. And Dan, over to you. I mean, I guess the question for you is: Are you scared about a large bank sort of setting up a rival product to Parpera and coming to eat your lunch? What are your thoughts on that?
No, I'm not. And I think Arvind did it really well. So back in 2016, when I got to the UK, I was in the UK for 6 months before I started my MBA at London Business School. Monzo and Revolut were just getting started, and I did a little bit of work with NAB on their Clydesdale Bank transaction. And it was a demerger. And it was the first time I sat within the bank. Previous to that, I was always consulting to banks. But combining all that experience, I always wanted to start a digital bank. And everyone said to me, don't do it, the banks are going to do it. What's going to stop the bank from coming to just do it? Like, they've got distribution, they've got existing customers. But what it fails technology are the key points that Arvind made, which is there's an incredible amount of legacy, both culture, technology, operational processes, and to change that is incredibly hard, because if you've got executives that are incentivized by different metrics, their metrics are not how do we build the next best digital bank that serves customers in a certain way. Their metrics are either how do we drive efficiencies, how do we improve return on equity, we run a net interest margin business, so how do we lend more money to customers? And they tend to focus on the segments where they can achieve those metrics. And so if you're an executive sitting in a bank, yes, you know there are FinTechs, then how do you motivate your entire team to shift and drop what they're doing, which in today's market where interest rates are high is extremely profitable? What's the burning need to change? And if we look into, and so am I scared? No, because we've seen how this played out in the UK. There is not a developed market in the world that doesn't have a FinTech that's already come to market and captured a large bunch of market share. And then the banks, yes, they have tried to deploy competing propositions, but they never ever resonate as well as the FinTechs do with the customer, because they don't have a human touch. It's faceless. You don't have the founder calling the customers and saying, you know, what do you think? What do you need? How's it working? What can we do better? If we can move back into sort of what we do at Parpera, we have a product collaboration board. And you mentioned earlier, Ben, that you are a customer and that we're releasing new features. Our new features are driven by suggestions that our customers make. And when we want to execute on that, we don't need to put together a business case and send it to our executive leadership team and then to the board and then get investment and do a 3 to 6 month cycle. It's a bunch of us in the room that say, yep, let's build it. And so we build it, we test it, we release it, we get feedback, we iterate, and that cycle happens really, really quickly. And so, you know, AMP announced last week, I believe, or the week before, that they're going to have an SME proposition aimed at micro businesses by 2025. They're going to invest $60 million to develop that. I mean, one part of, I could sit there and be like, oh my God, Parpera is doomed. How are we ever going to compete? Or well, the way I actually receive it is like, that's really good validation of the market. Fantastic. There's obviously a need. They see an opportunity there. And it's probably going to take them longer than 2025 to get to market, by which case, like we would be a substantial business by that point in time if we are still in business. So no, I don't believe a bank will build what we're building. Many have tried, many have failed to do it internally, globally, and therefore that's why partnerships are really important, because they can invest, they can learn and provide the distribution, and we can win together. So if we think about like micro business specifically, just to use that as a working example, businesses that are small and have 0 to 4 employees don't have high lending needs. They're not very profitable for a business bank to serve, but it's still important for them to capture them, because you can make money from other ways and you can add value in other ways. And when micro businesses want to be served, they want the end-to-end value proposition. So a bank's not going to build accounting functionality because it's just not their place to play. And these businesses don't need deep functionality. They just need a high level. And so if we look at the Australian market specifically, we've gone back in the 2000s of an evolution from branches to online. We've then gone from online to mobile, but that transition hasn't fully happened here in Australia. And what's driving it? It's not just technology, it's actually a generational shift. So in the next 5 to 10 years, 65% of our workforce in Australia are going to be millennials. And the way we like to do business and live our lives is actually on our mobiles. And so I don't want to go to the branch to open up my account and verify my ID. I don't want to do a phone call where the banker sits on the other side for 15 seconds and looks at my face and takes a screenshot. And I just did that recently. I want to be able to just open my app. I actually don't want to talk to anyone, not because I'm antisocial, but I've got a lot going on. And our customers don't want to talk to us. We don't call them. We try, they don't pick up, but we SMS them or message them through the app, they respond straight away. And so it's just the way you go to market and serve these businesses is fundamentally different. And you need leaders of new FinTechs to understand that segment to serve them better. And I think that's where banks will struggle, because the people that are leading banks, really talented, really intelligent, but there's a disconnect between the way they live life and do business to the customers they're serving. So you're never really going to get that same connectivity.
Yeah, no, well articulated. Thanks for.
As you can see, I'm very passionate.
Absolutely, no, that's a great answer. Okay, changing tack ever so slightly, when we're just trying to sort of hone in on the attributes for success amongst FinTech founders and amongst FinTechs. We often hear a lot about sort of founder grit, founder resilience, being in the arena. You know, setting up a FinTech or any kind of startup and going out on your own is extremely hard. You know, I'm not brave enough to do it. Is the founder grit and resilience over romanticized in lieu of other attributes? Arvind, I'll start with you. Are there sort of other attributes that maybe, ultimately carry more sway? Because, when we're in a market like we are at the moment, with all the grid in the world, sometimes it can just not be enough on its own. What are your thoughts on that?
I can give a view based on some of the founders I've interacted with, but I think Daniel would be in a better position to comment on it. But one common thread which comes across, Ben, is definitely you need to be brave. It's not an easy place to be in. It requires a lot of resilience, perseverance, because it is a journey. If you've got a mindset that, hey, let me get it up and running and I want to then sell it out and get out of it, that's not the most, I would say that's not a successful personality trait that you would need in this market. The ones who've been really successful, and I don't want to make them sound a bit more crazy, but you need that passion to continue and own the business. Obviously, this leads to borderline control issues, and they want to control everything forever instead of handing over to professional management. But definitely, you need to be brave, patience, and you need the passion. I would say, and it's not over romanticized, because I would say that everyone I've come across has been extremely passionate in terms of what they believe in. And I think that is extremely important because you're leading a very small team to start with. So if you're not able to have or able to demonstrate that, you will never be able to motivate your small team to continue with the drive, and also be able to communicate to your investors and stakeholders that you can make it happen.
Fantastic. Dan, thoughts?
Yeah, I think Arvind's articulated really well. I guess at a high level, like I've said this before on our previous panel, Ben, like founding a business is a highly irrational decision. There's no reason, like there's no logical reason to do it. Like you can get a good job and get paid and live a good life. Like you don't need to found a business, right? So you need to be motivated by something else. You need to be really passionate about solving a problem. Is it over romanticized? No, it's not. Is it? And I don't sit here, by the way, on this panel saying, "Oh, look at me! Look, I'm this really resilient founder." And it's not. You don't think of it in those terms. You do need to be driven by the passion. If you're driven by financial return only, well, the second something goes wrong, it's done, because you realize that money's not going to be there, and you'll start to look for other opportunities. And there are points along the journey where even myself, I'm looking at that and saying, well, my opportunity cost of doing this versus. But I really love the journey, and I've come to love it as well. I used to be about the destination, and actually every day there's successes and failures every single day, and our whole team loves the roller coaster. Some of them say like their life is so stable personally that they get a kick out of coming to work because every day is a new adventure. But to go back to that, what I really love about the founder's journey and being a fintech founder as well is that I get to apply everything that I've learned in my life to what I do. So it can span from market sizing to technology, going all the way deep to the architecture and understanding like how it all hangs together, to value proposition design, to pricing, to talking to customers. Every day we get to do everything at this early stage. And then if I go back into that irrationality, what's cool about it is that you dream something up. And if we look at sort of 3.5 years ago, and Ben, you've been close to that journey from the start, all the stuff we said we would do, we have now built. And that didn't exist before. And so we've created something that never existed that people get value out of. Now, our biggest challenge as a small fintech is creating awareness, but we can see in the traction that's building that people are using it and love it. And so that then motivates us to keep going and to think of other things. There's a question from Tom around international opportunities and bootstrap fintechs. I might address it as part of this, if that's okay.
I'm the moderator, but yeah, you can take over. Go ahead, absolutely.
And I'm a founder, like it's very natural for me to just sort of take controllers up and sit and just go on.
Go for it. Let's jump into some questions. I've still got some more for you, but yeah.
No, that's cool. But it's relevant to what I was saying, because around the resilience piece, like are the opportunities to go overseas? Again, there's enough to do here. It's a highly underserved, under-innovated market, under-invested market from a fintech perspective compared to the rest of the world. It is challenging to raise money here, so there's a temptation to look for opportunities overseas. But I would say that if you're able to find a business model that works here, and there are still wedges in other markets, developed markets as well, where you can enter. So the UK, as much as it is a saturated market, there are still opportunities there because it's cyclical. So for example, banks that used to bank a certain type of customer base, because the cost of capital is high, regulatory requirements get higher, they then pull out of certain markets and segments. And so over a 5 to 10 year journey, opportunities that were there 10 years ago are there again today. And so there are opportunities to go overseas. I won't go into a lot of detail. And then his question was around also, is now the time to bootstrap a fintech? I think bootstrapping a fintech is a bit of a misnomer. It kind of implies that you have a chunk of capital that you can take risk with personally, because it's not cheap to go and build the infrastructure. And so I think it's a really dangerous idea that we can have a fintech industry that thrives in Australia by bootstrapping it. Because who can bootstrap a fintech? Well, you need to be maybe an ex-banker that's made a lot of money, or someone that's exited a startup. And Australia, we don't have a lot of fintech startups, so there's not like second-time fintech founders that have chunks of cash that are going to start fintechs. So if you are a banker or someone that hasn't come from fintech and you try to start a fintech, it's a tech-driven proposition, and bankers aren't well placed to build tech-driven propositions. And so we've seen really well-funded startups from those types of characters that never get off the ground because they burn all the capital because they don't know what they're doing. So I don't think the answer is to bootstrap a fintech. It's not we're a fintech SaaS business. But the SaaS part is not like I just sell a widget online and it's service-based, and there's a cost to serve and there's a compliance cost, and all that needs to be done right, because as Arvind mentioned earlier, from day one, the second we transact $1, we need to have all the controls and processes in place. So I think I've gone on a bit of a tangent, but is resilience important? The only way you succeed is to be resilient, because otherwise, if you don't have resilience, you're just going to give up.
Arvind, I'm sure you've sort of...
Yeah, and Ben, just before you go ahead, I don't want these answers specifically to this question make the founders feel that we are taking off on them. No, it's just that what we are calling out is it's not an easy journey, and your mindset needs to be correct to be able to get on it, and it has to be a medium to long term, because it's not just you. You're leading a team. And you're responsible not just to your business, but to your team.
Yeah, really good point. I mean, like the team needs to be resilient as well. Like everyone that's involved. I mean, we haven't come up with the term investor resilience as well. Like you just need to be willing to take the risk and bet the long term, and like be behind the long term vision. It takes time.
And if anyone else on the webinar has any more questions, feel free to pop them into the Q&A section. Just following on from that question, and we'll turn it more positively in a minute. But I guess, is there a point, and we're sort of seeing this played out almost on a daily basis, sadly at the moment, but is there a point at which you need to pull up stumps and sort of admit defeat? Daniel, is there a time when, if there's capital left, it should be returned to investors? At what point, are you flogging the proverbial dead horse? When would, how would a founder go about sort of making that very, very difficult and very, very emotional and very, very tough decision?
Yeah, I think there are two sides to that question. So one is like, when's time from, let's take the emotion out of it, and let's assume you're operating, you want to do the right thing. When you have runway that can't meet your obligations and you're at risk of being insolvent, you have to stop. That's very simple. And you need to build that in as well. Like if you're a founder sitting there and you've got less than 12 months of runway and you don't know what that point of time is, then you're already being negligent. Funds always take longer to raise than you want to. The metrics are always high. So there's this balance that you need to maintain. The second question of like, when do you give investor money back is a different question. So that's assuming that you have the money and you're operating and it's not working and you can't see it working. If you fundamentally believe that you can't see it working, then that could be the catalyst to give it back. But it's an incredibly difficult decision. And because founding business and doing this is quite irrational, there is a risk that founders become a bit delusional as well and believe that they will find a way forward. And so I guess the way I tackle that is like, we have advisors around us. We look at the hard metrics and data, and we really challenge ourselves on, is this working? And what are the assumptions that need to be true to keep going? And what are the signals that indicate that, hey, we may not make it? And fortunate for us as to where we are in our journey, the signals suggest we should keep going. So that keeps driving us forward.
And Ben, I'd like to add one thing to it. Like we've spoken about the founders, we've spoken about the team, but the important thing that Daniel brought up just now is advisors. I think you need to have a few of those to do a reality check of a sounding board on a regular basis. Because yes, you have a great idea, but as Daniel said, it's very easy to get lost in your passion. And having somebody to check in on a regular basis, it can come from a variety of sources, but it is always good to check in and ensure that you are on the right path.
Yeah, no, I'd sort of echo those sentiments, and I guess that's sort of the role of the board, providing governance and advisors who are, I guess, serious and seasoned advisors, and aren't just sort of going to tell a founder what they want to hear.
Yeah, I think, Ben, just to, like, investors give you capital. Investors give you capital, or should be giving you capital, understanding the risk involved. And it's hard to get your head around this as a founder because you never want to lose money for people. And it's quite a scary thing to take on capital and with the prospect of losing it. But they've given you that capital because they backed you, and it's your responsibility to find a way to make it work. So as I said, unless you're trading insolvent, which you shouldn't be doing, but you need to figure out, if it doesn't work, how do you pivot? How do you find it? Like, you need to make it work, and that's all based on having the thesis at the start and the business model and the vision, and all that needs to stack up. But if you fundamentally believe in what you're doing, you will find a way to make it work. But you need to manage the externalities as well, and it can be a reality where the market doesn't pick up and fintech funding is very dry. In which case, it's out of my control. It's out of the market's control. And then that day may come, but until that day comes, we'll keep pushing ahead, and I think that's what a founder needs to do.
Okay, fantastic. I've got one more question, and then we're going to go to a quick fire round, if that's okay, just to close it out and keep you on your toes. I've been probably too gentle with the questions. I just listened to a podcast. I was learning about a US company called Traba. And they're backed by Keith Rabois and Founders Fund in the US, and they have a culture where they are in the office 12 hours a day, 4 days a week, 10 hours a day on Friday, and I think they probably go in and work weekends, and that's across the entire company. So that's a non-negotiable. Obviously, that sounds extreme, that they let people know what they're signing up for on their way in, and they're trying to sort of create this collegiate culture of a startup and become a $1 trillion company. They're very, very clear about that. I guess a question for each of you, maybe starting with you, Arvind, and then going on to Daniel, is in terms of the sort of culture and the requirements to create a successful startup. What sort of that look like for you, Daniel, in terms of hiring, and Arvind, just what you're seeing, particularly in APAC and Singapore?
So, first of all, when you work for a startup or you want to join a startup, you should know what are you signing up to. It's the risk, because you have a risk that the startup, like what Dan mentioned, that how long it survives, there could be a cutoff. What is your fallback option? So you should know what are you signing up to. The second piece, which comes with any business, even in a traditional organization, as you're trying to grow a specific or a new line of business, is the initial hard work that goes in. I'm not a big fan, I'll be very honest with you, Ben, with somebody enforcing this kind of thing, because what works for it's not one size fits all. Let's be very honest. So you can't just have everybody working 12 hours, 10 hours. But as I said, you should know what you're signing up to. Then the second piece comes in is, which we've spoken about a bit, is the team needs to be resilient, but the team needs to be equally passionate. And if they are, they will work hard. Every startup I've come across, the smaller they are, the harder they work. And it only eases up as they get much bigger. So it is a challenge. It's not a culture that we should be pushing for, because bringing in the traditional thought, but there's something called work-life balance that needs to be in place. And as I said, it's not that you just do for 3 months and you're done with it. A startup journey is much longer than 3 months. So it's a very difficult question to answer, to be really honest with you. But as I said, all these startups I've come across, they're extremely passionate and work really late hours.
And Dan, how would it go if you were running mandatory 12? I know you're running 12-hour days, but across the entire team.
Yeah, I think it's again, this comes back to like cultural context. In the US, you might be able to actually run a business like that. There is a more of a work hard, play hard type culture, a greater pool of people that want to do that. So me personally, yes, I work 6 days a week. I will work 12, maybe more, whatever it takes, I'll do. And I get excited. Like I might be tired and an opportunity comes and all of a sudden I'm energized and I'll just work until that drives me. But can I build a sustainable business and team by expecting that on everyone? No. So someone that could be really, really good at what they do may not have that same sort of outlook. And if you're looking at the different functions across the business, each of those functions, engineers are different to marketers, are different to product people, and different to CEOs or business leaders. So we've been on a journey of 3.5 years, and I've also had to learn around moderating the energy that I put in day to day as well, because it is a marathon. It's a long journey. And so when I used to work in consulting, it would be common to do like 12, 18-hour days or whatever it takes to get a project done. But at the end of the project, you've kind of reset and you go into something new. You've got a whole new context and something new to get excited about. In this business, the challenges are just constant, and you can't just switch off. You can't just stop and walk away from it and start something new. And I think because you are in it for such a long period of time, you need to come up with sustainable ways of working. And so, to Arvind's point, what I've found is people just do it themselves. If they're passionate, they will invest the extra time. I mean, I'll give a shout out to both Cindy and A1. So Cindy, our product manager, and A1, our backend engineer. They will log on the weekend. I don't tell them to, but they will log on. They will look at problems. They will look at customer complaints because they want to succeed. Because they know if they respond, we're more likely to proceed and onboard more customers. We don't want to wait 2 days for them to come through. So they'll just address things. And so we're building a culture of that's purpose-driven, values-aligned, and we hire for people that are aligned in that way. And then everything else, I believe, like anyone can learn anything. They just need to have the right attitude. And actually, a lot of the skills that you need to build a successful fintech in Australia don't really exist in Australia because we don't have that many fintechs. And they don't come from a bank. They don't come from a different startup. It's actually a whole bunch of different skills that you need to bring together in context and understanding, which we're training from the ground up.
And I want to highlight the point that Daniel mentioned, sustainable. There's always a risk when you start pushing this hard as a leader. It's very important for you to keep the aspect of burnout in mind. And that will harm your business. So you need to be very conscious that how you're managing your resources, which is not just your money, but your people. And it's extremely important that you keep their state of mind and the welfare, as an important factor as you're working on this.
Yeah, we've seen it. Just a quick anecdote, like from our own experience, where we've had new joiners and the business is moving really, really fast, and that new joiner comes in and everything is just moving straight past them, and it's hard for them to get up to speed. And you want to keep growing the business, but actually you need to slow down and give them an opportunity to get onboarded. And it may take you 2 to 3 months to get them to where so they can run at the same pace that you were running at before. But if you don't do that, they'll just sort of come in and bounce straight out because it's just too intense. And so we've learned that the hard way. Like we've had a couple of people come through and it's been interesting, but it's been too intense. They haven't been able to see the culture. They haven't been able to like join into the intensity. And so we've had to learn ways that how do we slow things down? Because you've constantly got this pressure where you need to grow, you need to be lean, like you need to do lots with a little. And just managing that's really hard. And ultimately, when it comes to the employee value proposition, if they can get paid more working somewhere else and doing a lot less, in Australia, people have pretty good wages. And if you work for a corporate, like the hours aren't that long, and you can have a comfortable life. And we have a focus on work-life balance in this country, which does harm productivity in a way sometimes, I believe. But I believe more in work-life integration. and making it all kind of work for you, depending on whatever your objectives are as a person. And so when we bring people on board now, we make sure we spend the time to give them the time to learn, get up to speed, and then kind of iteratively expand the scope of their work.
And just to add, sorry, Ben, we're just going on this, but just to add the last piece, that you don't want to create a reputation in the market with your company, with your brand, that it's not a great place to work in. Attraction from a talent perspective, like what Daniel mentioned, there's always competition. There's always another place that they can work in, which gives them a higher salary and not as aggressive working hours. If you have a great culture in your company, people will want to work in your company. But if you have this kind of a forced culture, however much you pay over a period of time, you'll have a bad reputation and you'll attract the wrong kind of people.
Yeah, that makes sense. And I think there's been a few examples of that we don't need to go into. So we've gone pretty deep there on a few topics, gents. We're just going to finish off with a rapid fire round. No preparation for this. So I'm going to make a statement or ask a question, and I just want you each to give me your immediate answer or thought. Okay. So first one, what's the most used app on your phone? Arvind.
I would say one of the most used fintech apps I have is, I'm based in Singapore, so it's something called a Utrip. And it's basically a Hong Kong company and a Singapore company. It's basically more from a payments perspective and exchange. So it gives me very good market rates, especially when I travel. And I'm not about boasting here. I was in Bhutan and I could use the app there. So it works great. It's kind of a bit of a wallet for some currencies, but for the rest, anywhere I have been, I get really good exchange rates.
Tremendous. Daniel? Can't say Parpera, by the way.
I was going to say it is the Parpera app. And outside of that, I'm embarrassed to say that then it's a Big Four banking app after that, which is what I use to manage our company money. So
disappointing, but necessary. Okay, next one. What fintech idea do you wish you'd had? Daniel again, can't say Parpera. You go first.
Yeah, so I think it's a really cool opportunity for someone that can tackle this, and it could be something that maybe the future life I consider, but something that brings together, that enables the intergenerational wealth transfer. So looking at both non-financial and financial assets, and there is a banking component in this to facilitate the flow of money. But how do we help the exchange of money to go from the boomer generation to millennials, Gen Z, in the most equal way possible, where we can have a more or less inequality in society as we progress.
Wow, that is a...
Didn't expect that, did you?
Yeah, I didn't think of that. I didn't think you were going to say that. That sounds like a webinar in and of itself. Arvind, how about you?
The one I would call out is I wouldn't say it's a great innovative idea, but it's a pain point that I would like to be addressed, is more around insurance on the claims management. It's painful. And I hope somebody makes it easier when you have to integrate between the healthcare providers to the insurer to the payment, making this whole thing work. I hope somebody fixes it.
Fantastic. Okay, and with that, guys, I will thank you for your time. Daniel Cannizarro from Parpera, Arvind Swami from Red Hat, and we have used 58 of our 60 minutes. It's been a very informative, lively chat. Thank you for being so candid and open and sharing your views. We will either close out the meeting or hand back to FinTech Australia.
Yeah, thanks again. Thank you all attendees for tuning in, and to Ben for driving such a valuable discussion today. Lastly, thanks so much to Dan and Arvind for your time and your willingness to share not only your stories, but your learnings and your expertise with everyone that tuned in today. So thanks, everyone.
Thanks a lot, everyone.
Thanks everyone.
Thanks, Arvind.